Today, we're looking at a financial analysis report on a tactical trade for SQQQ.
Yes, the core thesis is a short-term bounce off that critical $65 to $66 support level, all based on some expected weakness in the tech sector.
Let's start with what's working really well. And for me, it's the clarity. The sheer specificity of the tactical strategy here is excellent.
It really is.
There's no ambiguity. You get a dip by zone, you get precise targets, and a very clear stop loss at 63.40.
And that's exactly what you need for this kind of sniper trade, right?
Exactly. It's immediately actionable.
And I have to say, the narrative is just compelling. The whole coiled like a spring metaphor, it immediately sells the risk-reward setup.
It really does. It gets you hooked. The foundation is absolutely solid.
Okay, so let's get into it.
Let's pivot to the 3 areas where we think this analysis can be, really elevated.
Let's do it.
So let's start with this tension I see. The title makes this huge, definitive claim. 66 is the bottom.
Right, very high conviction.
But then the analysis itself acknowledges that the real hard stop, the 52-week low, is actually all the way down at 63.40.
And that's a problem. That creates this, $2.60 buffer zone that it's not analyzed.
It's an analytical hole. The analysis talks about 66 as this psychological floor, which is great framing. But what happens if the price breaks that floor but holds above the stop? Let's say it hits 64.50. What's the play then?
Exactly. The report doesn't give you a roadmap for that scenario. It makes the entry feel like a binary bet on $66 holding.
Yeah, it's a bit of a gamble rather than a structured risk approach.
So to strengthen this, the suggestion is to really model the trading behavior inside that buffer zone.
Turn it from a binary call into a more nuanced risk management strategy.
Right. This is where you can add some serious quantitative depth.
So, for example, you could break the entry down into tranches.
I like that.
Maybe you suggest allocating, say, 40% of the position near the top of the zone, around 66.50.
And then you average down with the other 60% if it moves closer to 65 or even 64.
Exactly. That respects the volatility of a leveraged instrument like this. It gives a trader a plan.
And you could do more to justify that 63.40 stop loss, too.
Yes. Right now, it's just the 52-week low.
You need to give it more analytical muscle. Dig into the historical volume profile. Was there major accumulation at that level in the past?
Or does it line up with some longer-term Fibonacci level? Give the reader a reason to believe in that number, beyond just a calendar date.
And you mentioned the implied volatility, that it's around 55%. That's a huge piece of the puzzle.
It is.
You should integrate that. Does that 55 IV suggest that a quick dip below 66 is almost a statistical certainty?
If so, frame that dip not as a failure of the thesis, but as the prime opportunity to complete a position.
Exactly. It turns that scary buffer zone into a structured zone of opportunity.
Okay, let's shift gears. Second point. Let's talk about the catalyst.
The why now?
Yes, the why now. The technicals are laid out clearly, but the fundamental catalyst feels, a bit too generic.
I agree. It points to any weakness in major AI stocks and the NASDAQ needing to take a breather.
For this level of analysis, that's just not specific enough. You're making a trade that goes against a very powerful bull market in tech.
Right. The report itself admits the broader trend is bearish for SQQQ.
So if you're going to make that contrarian bet, your catalyst can't be some vague hope for weakness. It needs to be sharp, imminent.
So the weakness here is that reliance on a generalization. The suggestion then is to link the technical picture, like the oversold RSI, to a very specific, observable, fundamental friction point.
Yes, something that makes the retreat likely to happen now.
So what could that be? Instead of just any weakness, think about market structure.
Are there specific quarter-end rebalancing flows coming up that might force profit-taking in big tech?
Or maybe some corporate lockup periods expiring for a major NASDAQ component. Something tangible that provides a timing mechanism.
And if you're going to use the AI stocks as the example, you have to give a specific pressure point.
Don't just say NVIDIA. Say, a potential supply chain bottleneck that might impact their next guidance.
Or maybe a shift in institutional options activity that shows major players are hedging against a drop in Microsoft.
That turns it from a vague idea into a real, testable hypothesis.
And to back up that seller exhaustion thesis beyond just RSI, you could look at institutional flows. Is money actually rotating out of QQQ?
Or is the premium on call options flattening out? That's the kind of hard data that validates the chart and makes the whole argument much more robust.
Okay, so that brings us to our third and final point. This one is more about presentation and flow.
The tone.
The tone, exactly. Harmonizing that high-impact promotional language at the start with the very dry data that follows.
And the hook is great. Perfect dip buy with a rocket emoji. It's high energy. It pulls you in.
It does. It creates this sense of urgency. But then the energy it dissipates.
It really does. You transition to this list of stats. 66.49 close, 0.77 drop. And it just feels like a different document.
It's a tonal disconnect. The reader is all fired up from the intro, and then they're hit with this very neutral descriptive recap.
So the suggestion here is to carry that high-stakes energy through the entire analysis.
Yes, every single number you present needs to be framed as evidence that proves your thesis.
So take that line about the intraday action. The report says, SQQQ struggled immediately, but managed to reclaim over $1.
Right. Right now, that's just stated as a fact, a neutral observation.
Don't let it be neutral. Frame that. That's not just a reclaim. That's a determined rejection of the lower bound.
Or it's a flash reversal that serves as concrete evidence of seller exhaustion. Show the reader why that $1 move matters right now.
And that 55% implied volatility figure, you should bring that in way earlier.
Oh, absolutely.
Use it when you're setting up the risk-reward. Quantify the potential bounce. A 55 IV means the market is pricing in a big move.
Use that number to make your price target of 71.64 feel not just possible, but urgent and probable.
Yes. And structurally, the Why This Matters section should directly set up how the numbers you're about to show prove that coiled spring metaphor.
So the reader is never left wondering, okay, why am I reading this specific number? The narrative and the data should be tightly linked.
At the end of the day, this report has a fantastic